If you have zero experience, little money, and no idea where to start investing, this is for you. Because most people don't avoid investing because they're lazy. They avoid it because they're confused. Stocks, crypto, ETFs, real estate, risk, recession, inflation. It feels overwhelming. So they do nothing. And doing nothing is the most expensive mistake you can make. Let me tell you something clearly. Investing is not about being rich. It's about building freedom. And you don't need thousands of dollars to start. You need structure. So let's break it down step by step. First, understand this. Investing is not gambling. Gambling is hoping to get lucky. Investing is using time, consistency, and ownership to grow money. If you are looking to double your money next month, stop watching. That mindset will destroy you. Real investing is slow. And that's exactly why it works. Now, step number 1. Before you invest a single dollar, build an emergency fund. This means saving at least 3 to 6 months of basic expenses. Why? Because if your car breaks down or you lose your job and all your money is invested, you'll be forced to sell at the worst possible time. And beginners always lose money when they panic sell. Stability first. Growth second. Step number 2. Eliminate high-interest debt. If you are paying 20% interest on a credit card, no safe investment will beat that consistently. Pay off toxic debt first. Investing while drowning in bad debt is like trying to fill a bucket with a hole. Now, step number 3. Understand risk. Investing is not a straight line. Markets go up. Markets go down. Sometimes they drop 20%, sometimes 30%. If seeing your money go down makes you panic, you need to adjust your strategy because emotional investing destroys portfolios. Now, let's talk about where to actually start. The easiest starting point for beginners is broad market investing. Instead of trying to pick the next Apple or Tesla, you invest in the entire market. This is done through index funds or ETFs. An index fund simply tracks a large group of companies. For example, some funds track the top 500 companies in the US. That means instead of betting on one company, you own small pieces of hundreds of them. This reduces risk dramatically. Historically, broad market funds have averaged solid long-term returns over decades. Not overnight, over decades. And that's the key word. Long-term. If you invest $200 per month consistently, even at moderate returns, over 10, 15, or 20 years, the growth becomes powerful. Why? Because of compound interest. Compound interest means your money earns returns. Then those returns earn returns. Then those returns earn even more returns. It's like planting a tree. The first years, it looks small, slow, almost disappointing. But after enough time, it grows beyond what you imagined. Now, here's another important concept. Consistency beats intensity. You don't need to invest a lot. You need to invest regularly, monthly, automatically if possible. Remove emotion from the process. Automation is powerful. When investing becomes automatic, it becomes a habit. And habits build wealth. Now let's talk about a mistake most beginners make. They chase trends. They see a stock going viral. They hear about crypto exploding. They watch someone online claiming they made 10x in a month. And they jump in late. That's not investing. That's emotional reaction. And emotional reactions cost money. Smart investors don't chase hype. They follow a plan. Now let's build a simple beginner plan. Step 1. Emergency fund. Step 2. No high-interest debt. Step 3. Open a brokerage account in a regulated platform. Step 4. Start with a broad market ETF or index fund. Step 5. Invest consistently every month. Step 6. Do not panic when markets drop, because they will drop. And when they drop, that's not the time to run. That's the time to stay disciplined. Now let's talk about time. If you're young, time is your biggest asset. Not money, time. Someone who invests $300 per month starting at 20 years old will likely end up with far more money than someone who starts at 35 investing double that amount. Because time multiplies money. The earlier you start, the easier it becomes. And here's something most people don't understand. The goal is not to get rich quickly. The goal is to stop depending only on your job. Because when you invest, you buy ownership. Ownership in companies, ownership in assets, ownership in growth, and ownership changes your position in life. Employees trade time for money. Owners let money grow over time. Now, I want you to think about this. If you invest nothing for the next 10 years, where will you be? And if you invest consistently for the next 10 years, where could you be? The difference between those two futures is discipline, not intelligence, not luck. Discipline. Investing from zero is not about being perfect. It's about starting. Starting small, starting smart, and staying consistent. Because financial freedom is not built in one year. It's built decision by decision, month by month, habit by habit. And the best time to start was yesterday. The second best time is today.